When you form a business, you need to initially decide what type of business entity will best suit your needs. The following are the most common business entities you can consider for conducting your business. The first option is a sole proprietorship. A second option is a general partnership. A third option is a limited partnership. Other options include an LLC or limited liability company, a C corporation, and an S corporation. What business entity you choose depends on the relative importance of four main issues. The first issue is their relative costs and complexity. The reporting requirements also can vary greatly between your various choices. You also have to consider the importance of limiting personal liability when you choose your business entity. With some options, you have unlimited personal liability for business debts and lawsuits against your business. Choosing a particular business entity will have major tax implications. As a result, it's important to choose it wisely. The other factor you must consider when choosing your business entity will be whether or not you need to raise outside capital. If you are a one-person business and you want to avoid registering with the state and you don't want to file multiple tax returns, then a sole proprietorship might be right for you. A sole proprietorship is the easiest business entity to run and set up. Business income and losses are reported on your personal tax return. A general partnership is very similar to a sole proprietorship, except it involves more than one person. Like the sole proprietorship, partnership income and losses are passed through to the partners and reported on their personal tax return. A yearly partnership tax return is required in order to explain to the federal and state governments the income and losses generated by the partnership and how they were passed through to the partners. Limited partnerships are usually created by one person or company called a general partner who solicits investments from others called limited partners. The general partner manages the company and the limited partners are passive investors. Limited partnerships are costly and complicated to set up and run. They are not recommended for the average small business owner. If personal liability is a big concern, then you do not want to set up your business as a sole proprietorship or as a general partnership. With these entities, you have unlimited personal liability if someone decides to sue your business. The only way to limit your liability is to set up your business as a limited liability company, an LLC, or as a corporation. In a limited partnership, limited partners have minimal control over daily business decisions and operations. As a result, they're not personally liable for business debts or claims. The next big consideration in choosing your business entity is taxes. With regards to taxes, LLCs have the most flexibility. If you're a single-person business, you can elect to be taxed like a sole proprietorship. In this case, income and losses from the LLC are passed through to the owner and are reported on your Schedule C personal tax return. If you have an LLC and have more than one business owner, you can elect to be taxed like a partnership. In this case, you need to file a 1065 partnership tax return that reports how the income and losses were passed down to the individual partners. With an LLC, you can also elect to have the IRS tax you as either a C corporation or as an S corporation. A C corporation is considered a separate tax entity and pays corporate taxes based on their income and losses. One major tax benefit of setting up as a C corporation is that fringe benefits such as medical insurance premiums and direct reimbursement of medical expenses are deductible expenses for the corporation and are not treated as taxable income to the employees. S Corps do not have the same benefits of tax deductibility for fringe benefits that C Corps enjoy. With S Corps, fringe benefits are not tax deductible for owners that are considered key shareholders. Unfortunately, you only have to own 2% or more of the company to be considered a key shareholder. The bad news only gets worse. IRS attribution rules also disallow tax deductions for fringe benefits given to spouses of key shareholders. One major negative tax issue you need to consider with C Corps is the potential for double taxation. This is especially true if a C Corp holds property or assets that are likely to increase in value. If these properties or assets are sold, or if the corporation is liquidated, taxes are paid by both the corporation and the shareholders. One way to reduce double taxation is to pay most or all of your profits out in the form of salaries. The one big drawback to this tactic, however, is that you then owe self-employment taxes such as Social Security and Medicare taxes on that income. These taxes can decrease your take-home pay by over 15%. One way to avoid double taxes is to set up your business as an S corporation. Like an LLC, an S corporation can pass through profits and losses to the shareholders. This pass-through nature of income and losses means that the corporation's profits are only taxed once at the shareholder level. S corporations have one major tax advantage over that of an LLC. With LLCs, self-employment tax, which includes Social Security and Medicare taxes, can be imposed on an LLC's owner's entire share of LLC profits. This can amount to 15.3% on the first $94,200 of wages and 2.9% on anything above that. For an S corporation, the rules for self-employment taxes are different. As an S corporation shareholder, you only pay Social Security and Medicare taxes on the money you receive as compensation for services. You are not liable for self-employment taxes on profits that pass through to you as a shareholder. It is important to note that S Corp shareholders are required to take a salary that is equivalent to the fair market value for the services that they provide the corporation. You are also required to withdraw and report quarterly payroll taxes. The last thing you must consider when choosing a business entity is your need to raise capital. If you plan on having multiple investors or doing a public stock offering, you need to set up your business as a C corporation. This is because investors want tangible evidence of their partial ownership in your business in the form of corporate stock certificates. This is not possible with an LLC. An S corporation has some major limitations when it comes to raising venture capital. One problem is that S corporations can only have 100 stockholders. S corporation stockholders must also be natural persons. They also have to be either U.S. citizens or legal U.S. residents. This type of business entity is also problematic when it comes to raising capital because it can only issue one class of stock. This stock requirement is fatal to venture capital investment since venture capital firms will demand preferred stock in return for their investment. Also, most venture capital firms are organized as either limited partnerships or LLCs. Both of these legal entity types are not natural persons and thus cannot be stockholders in an S corporation. As a result, C corporations are the only type of corporation viable for venture capital investment. This stockholder rule also prevents you from using self-directed IRA money to fund a business that is an S corp. I hope this information was helpful. If you're looking for business solutions, an excellent website to check out is NewBusinessCreator.com. So ask yourself right now, what is your current business goal? Do you need to create a business plan or find key personnel? Are you an inventor that needs to find ways to protect, sell, or license your intellectual property? Is raising business capital your primary concern, or are you looking for sales and marketing solutions? Whatever your business goal may be, in most cases, you can find a solution in NewBusinessCreator.com.